Imagine this. The stock market crashes. News channels panic. Social media tells everyone to sell immediately. Most people are terrified. But smart investors do something completely different. Instead of selling, they start buying. Why would anyone buy when prices are falling? The answer could completely change the way you invest forever. Let's start with a simple truth. Humans are emotional. When prices go up, people feel excited. When prices fall, fear takes control. People stop thinking logically. They only think about losing money. That's exactly why markets become emotional. And emotions create opportunities. Imagine your favorite smartphone costs $1,000 today. Tomorrow, it's on sale for $700. Would you be upset? Of course not. You'd probably be excited, because you're getting the exact same product for a much lower price. The stock market works in a surprisingly similar way. When great companies become cheaper, smart investors don't panic. They see a sale. Let's answer an important question. Why does the stock market fall in the first place? Many people think falling markets are unusual, but they're actually a normal part of investing. Markets move in cycles. Sometimes prices rise too quickly. Eventually, the market takes a break. This is called a market correction. Corrections can feel scary, but they're completely normal. History tells an incredible story. Markets have crashed many times before. Investors have experienced recessions, financial crises, global pandemics, and unexpected world events. Each time, people believed the market would never recover, but history kept proving them wrong. Markets recovered and eventually reached new record highs. Now think about this. If great companies become cheaper, wouldn't that create an opportunity? That's exactly how smart investors think. They don't celebrate falling prices, but they understand what lower prices can mean. They know quality companies don't suddenly become bad businesses overnight. Sometimes only the price changes, and that's when patient investors slowly continue buying. Because they know exactly what will happen tomorrow, but because they trust the power of long-term invest. Now, let's talk about one of the smartest investing strategies. It's called dollar cost averaging. Instead of investing all your money at once, you invest a fixed amount on a regular schedule. For example, you invest $100 every month. When prices are high, you buy fewer shares. When prices fall, you automatically buy more shares, without trying to predict the perfect time. That's why this strategy removes emotion from investing. Many beginners believe they can buy at the absolute bottom and sell at the absolute top. It sounds easy, but almost nobody can do it consistently. Even experienced investors struggle to predict short-term market movements. The market can change in a single day, sometimes in a single hour. If you're waiting for the perfect moment, you might miss the recovery completely. That's why time in the market is usually more important than timing the market. Let's compare two investors. Investor A follows emotions. Investor B follows a plan. When the market falls, Investor A sells everything. Investor B continues investing later. The market begins recovering. Investor A regrets selling. Investor B benefits from buying at lower prices. Discipline often beats emotion in investing. So, what should you actually do the next time the market falls? First, don't panic. Remember, market crashes are temporary. Second, stick to your investment plan. Don't change your strategy because of fear. Third, continue investing regularly. Lower prices can allow you to buy more shares. Finally, think in years, not days. Long-term investors focus on where the market is going, not what happened this morning. Here's the biggest lesson from today's video. Smart investors don't love market crashes. They simply understand them. They know that fear creates opportunities, and patience turns opportunities into wealth. That's why successful investing isn't about predicting the future. It's about following a proven process, again and again, year after year. Let's quickly review everything we've learned today. Market crashes are a normal part of investing. Fear causes many investors to sell at the worst possible time. Disciplined investors continue investing. Dollar cost averaging helps remove emotions from investing. Time in the market is more powerful than trying to time the market. Every market crash in history has eventually been followed by a recovery. Stay patient, stay consistent, and let time do the heavy lifting. If you found this video helpful, subscribe to Investivo for simple investing and personal finance videos every week. Thank you for watching, and I'll see you in the next video.